I'm Krasibir from the Markets Trust, and we restore the market's trust in structured and hybrid products. For over 80 years, credit rating agencies have been helping professional investors to come up with an accurate risk assessment. However, what happened during the latest financial crisis, 2006-2007, was that the rating agencies, they were still fine, but a little bit late. So downgrades of structured products soared up long after the markets for structured products soared down. So many people on the market questioned, well, so are these rating agencies reliable? So can we still trust them? At the same time, it is more important than ever to have a good risk assessment of structured and hybrid products. We live in a society which is getting older and older. So pension funds can no longer cover their liabilities by just investing in government bonds. The yields are just too low. There are indeed products which have a yield, well, in a relevant area for pension funds and institutional investors, like for instance the so-called COCO bonds or contingent convertible bonds issued by major banks. They have a high yield, but they get converted into the bank's equity exactly at the moment when the bank is in trouble. So because of the high yield, it's a very interesting market, very quick growth, but the question is, what is the risk? So how can we measure the risk? Are we going to trust again the rating agencies for that? So this is exactly where the Markets Trust rating solution comes from. Today, we have all the necessary ingredients to build a 100% data-driven credit rating agency, which is fully independent and which is timely, so working basically in real near time. So we have the data from highly liquid derivatives and securities markets. We have much better regulatory disclosures and financial disclosures. We have the internet with news, articles, opinions, papers, and the natural language processing tools which can help us to analyze all this type of data. We have artificial intelligence, so a big progress in artificial intelligence in the latest years, where we can develop models which can help us with linking all these diverse types of data and eliciting different risk scenarios. Finally, what we have within the Markets Trust, we have one of the top experts in the area of hybrid securities on our advisory board, and part of the models developed by him are also used within our software. They combine quantitative and behavioral finance. How this solution can work at UBS. We have identified two main areas in which it can be helpful. First, in asset management, it can help your bank to grow the business, attract new institutional customers. 23% of institutional investors today name risk management as their #1 concern. So if you can provide an independent risk assessment in the area of structured and hybrid products, so in the most interesting area for all these investors, well, then you are in a good path to attract or retain these type of customers. The second area, which we have identified within UBS, is in the internal risk control. So we can help the bank to bring the internal risk management system, the internal rating system, to the next level. So we are able to identify, for example, credit rating downgrades, so more than 4 weeks earlier than what traditional rating agencies are going to do. Also, we are able to aggregate different types of data, structured and unstructured information, 10 times faster than a traditional legacy rating system would do. We have an incredible team, 15 people, very diverse, 8 different nationalities, 4 people with PhDs who are working on the product, 3 university professors already on our board. We have been hosted by BGL BNP Lux Future Lab, so the business incubator of BGL BNP, and we are in partnership with them. We have received the support of the Luxembourgish government, and we have received funding from the European Commission on a highly competitive innovation scheme. So next year we are looking for raising about 2.5 million euro in terms of private funding to match the public investment already done in our company, and we're also looking to welcome UBS and other major players as our first pilot customers for our product. Thank you very much for your attention.
Thanks for that. So I guess a couple of questions from me. Firstly, you say that you're 43 days earlier than a credit rating, a traditional credit agency downgrading. How far are you ahead of price moves? Because that's really what matters for investors. You're saying that there's a very, very big lag for traditional rating agencies to really understand credit deterioration. Mm-hmm. But if you're 43 days earlier than them, well, if the price has already moved way ahead of you and them, then what's the value proposition?
Well, in a way, what a traditional rating agency would do, they would focus mainly on the financial statements of the organization they want to rate, so it will be basically updated on a quarterly basis. And what we do is that we combine three sources of data. So first, the option markets, so things like implied volatility, so CDS rates. Second, the classical financial data, which again comes quarterly. And then third, the news. So it's essentially we estimate sentiment out of the news available for a given entity on the internet. So based on that, as a result of our backtesting analysis, we have come up with this, on average 43 days. So how does it compare to price movements? Well, it's not a system which can be used for this type of arbitrage or real-time strategy. So I wouldn't say that we're faster than the pricing movements, but again, it depends on it depends on the context. So sometimes if the news are already negative, then it is so we have seen a few cases where first there came kind of a negative sentiment in the news. Then there was a movement in the option markets, and finally there were kind of a further movements in the bond market. So indeed, it is quite possible that in some cases we are faster than the price movements itself under certain assets, but in other cases it might not be.
That's really the nub of my question. If the majority of the information is coming from price moves to inform when a rating is going to get downgraded, then it's not that useful for investors, right?
Well, it is. So I would let me put it like this: around a third of the information comes from price moves. Yes. And the other thing about the system is that it is not always the same price move. Like you have what we are looking at is let's say the derivatives and the option markets, which provide a kind of a forward-looking assessment of what it could be. So within our system, we have a pretty large-scale artificial intelligence or machine learning algorithm which constantly recalibrates a wide range of factors. So some of them are price moves. Let's say a third are price moves. Then you have a third which are classical financial figures, and then you have a third which comes like sentiment from the news. So I wouldn't say it is purely a price movement monitoring system.
Thank you very much.
All right, thank you.